Your parents bought a stock for $10,000. It's worth $400,000 today. You'd think that's a tax bill on $390,000 of gains. The IRS says none of those gains ever happened. Most people assume inherited money works like every other gain. You inherit it, so eventually you inherit the tax bill too. That's common enough that families rush to sell an inherited house or stock portfolio, afraid of a bill that, in most cases, was never coming. Here's the mechanic underneath it. Every asset has a cost basis, the number the IRS uses to measure your gain when you sell, usually just what you paid. While your parents are alive, that basis stays locked at whatever they paid decades ago. The moment the asset passes to you through their estate, that number resets to today's value. Go back to that $10,000 stock, now worth $400,000. If your parents sold it the day before they passed, they'd owe capital gains tax on $390,000 of growth. If you inherit it and sell it the next day, your new cost basis is $400,000. Your taxable gain isn't reduced. It's zero. Here's the part almost nobody explains. If your parents give you that stock while they're alive, trying to get ahead of taxes, you don't get a reset. You inherit their original basis instead. Same stock, same $400,000, but now you're holding their entire deferred tax bill. Waiting is what erases the gain. Receiving it early preserves it. So the myth that inheriting an asset just delays the tax bill has it exactly backwards. For nearly every capital asset in America, decades of embedded growth are never taxed at all. Not deferred, not discounted, erased the instant it passes through an estate instead of a sale. This is why estate planning focuses so heavily on which account holds an appreciated asset. Stocks, real estate, and business interests in a regular account get this reset. Retirement accounts like an IRA or 401k don't. Withdrawals are taxed as ordinary income no matter who takes them. If your family holds highly appreciated stock, real estate, or a business, the most expensive move is often selling it one generation too soon. Before anyone sells an inherited or aging appreciated asset, get the actual cost basis calculated first. That number can be worth more than the asset's next 5 years of growth. That's cash flow clarity.